Okay, so question number 4. Now, guys, keep in mind in the exam, accounting for employee benefits and share-based payments will be combined. So, part A is on sick leave, which is an employee entitlement. Now, how do we work out sick leave in this instance, in this question? Now, this is a non-vesting sick leave. You have 200 employees, each earn $400 a day. And each employee is entitled to 5 days of non-vesting accumulating sick leave, which means if they don't take the sick leave, they will not be paid. So you will be given a percentage as to how many employees take their sick leave. Now, in order to confuse you, I don't know whether it's to confuse you or not, you're given that 70% of unused sick leave will be taken during the year. That's all you need. And 30% will not take it at all. Okay, which you don't really need it. Okay, so let's start. Now, what is the sick leave expense here? What is the sick leave expense? Sick leave expense is, okay, now there are 200 employees, 200. Each employee is entitled to 5 days. There you go. So there are 1,000 days for all 200 employees. And they've already taken 300 days. They've already taken 300 days. So you need to minus that, which means they're entitled to 700 days in total. Okay. Now, what percentage of them will take the unused sick leave? 70%. 700 times 70%. And each gets paid $400 a day. There you go. Now, that gives you the sick leave expense, which is 196,000. All we need to do is just record this in the general journal. Now, this part of wages and salaries. You debit wages and salaries expense and you credit provision for sick leave. 196,000. That's what we have. All right, question number 2, guys. Question number 2 is on annual leave. Okay, so same concept. The only difference is there's a loading. Now, this loading means that 17.5% loading, which means if you earn $1, you get $1.175. That's how it works. So say, for example, if you earn $100 a day, when you take annual leave, you get $117.50. Now, that's the meaning of this loading. Okay. Right, now you're given 4 categories of employees. It's a law firm, you have managers, you have, okay, it's not managers, it's managers. Keep that in mind, it's managers. Just solicitors, admin workers, other. Okay, right. Each employee group gets, well, this is how much managers get paid, $450. Solicitors, admin workers, other employees. Okay, now how do we work out their accumulated sick leave days, or the closing balance of annual leave accumulated days? What you need to do is we need to take the opening balance, need to add 300, that's how much accumulated during the year, and you minus 250. Okay, so let's start with managers. Pay rate is 450. What am I doing? It's $450 a day. What is the closing balance? Okay, guys, so the closing balance is, okay, so managers, they've accumulated 100 days from previous year. For this year, they have 300 days of annual leave. They've already taken 250. So you minus that. That's how we get 150 days. Now, how do you work out accrued annual leave? Okay, so what you do is you take the loading, which is 1.175, multiply by the pay rate per day, times that by number of days they're entitled to annual leave. There you go. That's what managers. All right, solicitors. Oh, what's their pay rate? It's $350. Okay, and what's the closing balance of their annual leave accumulation. So it's 180 plus 500 minus 600. There you go. So what's the accrued annual leave? 1.175 times by 350 times by 80. There you go. Admin workers, how much they earn? $150 a day. And how do you work out the closing balance of their annual leave accumulation? 150 days they've accumulated from last year, and in this year they're entitled to 450 days. You minus 380, the number of days they've already taken in annual leave. Okay, admin workers, and the closing balance, sorry, accrued annual leave, that's what you get. There you go. Other, it's $100 a day. Okay, the opening balance is 90. They accumulated to 60, and you minus the number of days they've already taken. All right, so what do you have? It's 1.175 times by 100 days, sorry, times by $100 and times by 100 days. That gives you 11,750. All right, guys, so what is the closing balance? So the closing balance is the sum of these. That's a closing balance. 79,313, 32,900, 38,775, 11,750. There you go. And the opening balance of provision for annual leave is given as 32,100. You need to minus that to work out wages and salaries. There you go. That's what you have. That is the annual leave expense or wages and salaries expense for this year. There you go. All right, next, employee benefits and share-based payments, part C. All right, guys, for this question, what you need to do is you need to work out the remuneration expense of these options. So they've granted 75 share options, and there are 30 senior executives. So 75 share options to each of its 30 senior executives. And they need to work for 3 years in order to be entitled for these options. And the fair value of each option is estimated to be 25%. And they've estimated that 10% of their senior executives will leave during the vesting period. Okay, so what you need to do is you need to work out the remuneration expense, which is 30 options. So 30 executives, each is entitled to 75 options, and the exercise price of the option is $25. The estimated 10% will leave during the vesting period, which means only 90% will be able to will be eligible to exercise the options. Now this is the total remuneration expense, right? What you need to do is you need to divide that by 3, because each year you record 1/3 of the remuneration expense. That's it. So 1/3 will be 30 times 75 times 90% times 25. You divide this by 1/3. It's 16,875. It's the same amount for year 2, same amount for year 3 as well. That's all they do. Quite similar to depreciation under straight line method. Yeah, when you work out depreciation expense, you divide that by 3. to work out the depreciation expense per year. Yeah, it's like depreciation expense of a truck or equipment which has a useful life of 3 years. Okay, right. Let's move on to part D. Okay, again, they grant 50 share options to each of its 200 senior executives, right? And exercise price of the option is $18, and they estimated that 15% will leave within the next 2 years, and they will forfeit their eligibility by leaving or during the 2 years. Okay, so let's work out the remuneration expense. It's 76,005. Okay, so 50 options times by 200 executives times by 85% times by $18. Guys, for the first year, you need to divide that by 2. That's what you get, 76,500. So on the issue date of options, there is no transaction as the vesting period has not commenced. On 30th of June 2019, it's 76,500. 50 options, 200 executives, 85% will remain based on the estimations and the exercise price. Divide that by 2. Okay. Now, when it comes to the second year, they already know how many executives are remaining. Okay. So 15 managers. Now, you don't need to take this into account in the first year because it's still within the given threshold. 15 executive managers left in the first year, and another 25 will leave. Oh no, another 25 executives have left before the options vest, which means 40 executive managers in total left before the options vest. Okay, so 200 minus 40 gives you 160. Okay, so that's 160. 50 options, each executive is entitled to 50 options times by 18. That gives you the total remuneration expense, which is 144,000. Now, they had already recognized 76,500 in the first year. What you need to do is you need to minus that from 144, which is the total remuneration expense. That gives you 67,500. That's what you have. That's for the second year. All right, guys, I'll see you in the next video for question number 5. See you soon.